So next 40 minutes, we'll be discussing with my four fellow panelists the evolution of the infrastructure of this ecosystem. We're super lucky to have very experienced people that blending like traditional markets experience and crypto specializations. So maybe just as a quick start, if you want to introduce yourself, your company, very briefly.
Yeah, sure. I'll go first. First and foremost, many thanks to Das and the entire team for organizing the event and giving me the opportunity to speak today. Quickly, by way of background, my name is Mike Higgins. I'm the international CEO and global head of corporate development at Hidden Road Partners based in London. Prior to helping set up Hidden Road 6 years ago, I spent 20 years in electronic trading, multi-asset, and the bulk of my time in the foreign exchange markets. Briefly on Hidden Road, it's a multi-asset PB and clearing firm that was set up and funded by the buy side. So it's a sell side business funded with buy side pension fund capital. We've been focused on two things. One is to improve the technology behind the core infrastructure of prime clearing and margin finance in the traditional assets, and then applying those applications into digital. And second is we've taken an innovative approach to bring balance sheet into capital markets, including digital, by tapping into the large pools of private credit. And so summing up what we do as a prime broker, we're really access providers, access to two things. One is give access, uninterrupted access, I should say, to our clients to trade across the entire liquidity landscape. If you look at digital, it's highly fragmented across exchanges, OTC, and more of the regulated rails. So full access there. And then access to balance sheet. That's our balance sheet to trade across all of those in a capital and cost-efficient way.
I echo Mike with thanking Blockworks for the opportunity to speak today. Hi, everybody. My name is Chris Lawn. I'm CEO of Elwood Technologies. Our headquarters is in London as well. By way of background, my predominantly was global macro trading buy side, where I either built or ran trading desks or had a portfolio myself. I entered the digital asset space in 2017, and it's been quite a ride, for sure. And prior to becoming CEO of Elwood Technologies, I was on the Brevin Howard Principal Investment Team. It's been really, really remarkable what I've seen over the last few years, and we're getting there. So who and what is Elwood? We're a product and engineering-led technology company. We are SaaS. We are FCA regulated. We are front-to-back OEMS, PMS, risk system, and IBOR. We give our clients the ability to transfer risk across the digital ecosystem with our proprietary algos built by quants. We ingest that risk, whether you trade through us or anybody else. We view our post-trade as risk capture. Our responsibility is to work with our clients to make sure that we reflect your risk live all the time, basically. We have live reconciliation, and then essentially have risk metrics that are dozens and dozens of risk metrics, and we have a portfolio management and construction tool and an IBOR. So at the end of each day, if you're a fund, we will mark your books and records, which will lead up to striking NAV. We think of ourselves as a connectivity engine, so we are across the entire ecosystem. Market data providers, venues, LPs, credit providers, fund admins, you name it, we're connected to it. So we are in the space. We know what we're doing. And if you have any questions, feel free to. Do we have Q&A?
I doubt we'll have time for that, but
okay. Well, then I'll pass it on.
Cool. Thank you. I feel like if I don't thank Blockworks and keep the tradition, then I'm going to break it. So thank you for the opportunity to speak. I'm going to keep with the tradition as well. We're headquartered in London, so you've got a lot of headquartered businesses here. So I'm Tim Renew. I'm Deputy CEO of BCB Group. My background is not actually from digital assets at all. So I started in e-commerce marketing, very different, built a business that did that. Big investment from PayPal, that got me into fintech. Then I built a company that does real-time payments, powers real-time payments for businesses like Bank of America, Citi, National Australia Bank. And then I joined BCB 9 months ago to kind of take that on the journey because of the growth and what I was seeing in the market. And so BCB probably has the coolest name from every business here. It stands for Bitcoin Bro. Right, that's a badass name. Started off as a OTC trading desk back in 2017, and then realized it was impossible to get a bank account. And so once eventually managed to get an account, realized that we should kind of pivot and offer this services to the market, the ability to access banking partners. Since 2017, we've scaled massively. We now are regulated in the UK by the FCA, regulated in France, by the AMF, regulated in Switzerland. We're about 160 people. We provide payment accounts in circa 30 different currencies, provide stablecoin payments, crypto payments. Last year, we moved about 235 billion in fiat payments. So yeah, we're kind of core infrastructure for about 350, 400 of the leading exchanges, liquidity providers, and market makers within Europe and Southeast Asia. I'll hand over.
Cool. I'm Nikil. I'm from Alchemy. I'm basically the polar opposite of all these guys on the panel.
You're not from London?
I'm, first off, way
So
worse
thank you.
dressed. Not nearly as nicely
We
suited.
start fancy and gradually get worse.
Yeah, exactly. I'm not from London. I'm from rural Texas. So opposite of that. I don't work in finance. I haven't been in doing stocks for 20 years. I didn't even own a stock till a few years ago. I didn't even have a credit card till a few years ago. I instead spent my college coding AI systems at Stanford, and then spent the next 10 years doing that in my apartment room with my co-founder. We built a software company. How many of you have heard of AWS? Raise your hands. Okay, so kind of like half the room. Every time you open Uber or DoorDash or Google Maps, or not Google Maps, but any app you use, basically, Amazon actually powers all the computers that power that app. So if you every time you open Uber, Amazon makes money. Anytime you open a crypto app, we are powering the technology underneath that. So if you look at, you're playing with Robinhood, or you are buying something potentially on Coinbase, or you are buying an NFT on Facebook, or you're trading on DeFi or looking at an NFT, we're powering all the technology behind that. So very opposite experience, but a lot of fun. To give you a sense of scale, we worked for like basically 10 years with nothing. And then 2021 was a really great year for us. The ecosystem took off, and the company grew really fast. The last run we did was at $10 billion. And we do about over $100 billion in transactions annually. So you probably would not have heard of us, but we are the kind of behind the scenes technology powering the apps you use every day.
Okay, cool. That's very interesting. I think all of us have been one way or the other involved in the space for the last 5, 6, 7 years. And the way I like to look at things is kind of finding the defining moments of each one of the different verticals. And so maybe, Nikil, you mentioned like 2021 was clearly one defining moment. Maybe you want to spend a bit more time on this one and define exactly what it was. And then each one of you can share his own kind of defining moment.
Yeah, I think you guys will talk more about the banking fintech side. So let me address more the technology side. So a little bit historically, 2017 was when a lot of people started getting into crypto. We actually got into crypto because we were building a social app company, and the guys downstairs we'd play beer pong with were building a crypto Bitcoin company. And then we would always talk about Bitcoin. And that's actually what got us into crypto. 2017, 2018, 2019, 2020 was kind of this, hey, this crypto thing's kind of interesting. But when the market crashed, everyone said, yeah, that was fun, but we're done with that. That was not a real thing. 2021, you saw the first few like consumer use cases, namely NFTs. How many of you own an NFT? Raise your hand. Okay, a few of you. So 2021 is the year that really took off. After that market crash, so for example, we were working with some of the large banks, and they had these research teams building crypto projects. And so, for example, like loans on chain or tokenized equities. However, those were siloed to a few engineers in those large banks. The names are NDA'd, so I can't really say, but some of the banks that you guys probably use today. And after that, there was this uncertainty of, will crypto come back? Is it actually going to be a real thing? Coupled with the Biden administration kind of really strong crackdown on crypto, we saw there were small pockets of technology teams inside financial institutions, but they were scared, and there was a lot of risk on the core business of these banks and financial institutions. So they were effectively blocked from doing that. I think the last 3 weeks to 4 weeks have been probably the biggest shift we have seen. So there's 3 things that really need to happen in order for crypto to take off more mainstream, and we've seen progress in all of them. The first one is the technology has to mature to get scalable enough. And you see with all the layer 2s coming out, with Solana coming out, you see chains that can actually have close to the number of transactions that it would take to sustain major applications, if not exceeding that. The second thing is you need a good user experience. And there's a lot of technology advancements, things like account abstraction, that have made it possible to have great user experiences today that weren't possible 4 years ago. And then third one is regulatory. I'm sure most of you guys are familiar with the repeal of SAB 121, the OCC charter. There were a lot of things that absolutely flipped the bit in terms of banks and financial institutions and fintechs being allowed to build in crypto. And what we saw, at the risk of offending everyone in this room, you guys are not the fastest moving in general. And when I say you guys, I mean the Bank of America, the JP Morgan, these type of institutions. After the SAB 121 got repealed, the number of inbounds we got that said, we need to talk to you today or tomorrow. I was like, that is not a word you guys typically use in general. So given those three shifts in technology, we're seeing a massive rush from all financial institutions across the board, asset managers, fintechs, banks, to come jump into crypto. And I'm happy to talk later about what people are building.
Yeah. Maybe as we talk about banks, Tim, you want to jump in? I mean, clearly it is. I mean, we've seen the on-ramping of ramping 6 years ago was a disaster. It's getting better. Not that long ago, 12 months ago, we had a bit of a kind of banking crisis in the US as well, and that really dried up the liquidity for crypto traders and crypto kind of active businesses. Maybe do you want to elaborate this with your perspective?
Yeah, of course. So I think when you look at the world, most industries are led by the US. I think most industries, everyone looks at the US, what they're doing. Again, not to offend everyone in the room, but I actually think crypto was very much seems to be powering ahead across Asia and Europe a lot faster than adoption in the US is. And that was kind of enhanced with back in 2023 when you had things like Silvergate and you had Signature, you had Silicon Valley Bank close, and as you mentioned, the Biden administration's stance on crypto, maybe the SEC stance, meant that no one wanted to put their head above the parapet and stand out and work in crypto. And so, I think you find that a lot of institutions found overnight their access to US dollars was closed off, their access to a banking partner was closed off. And, you can't operate a business if overnight you're shut off. And so we saw a massive influx of people coming to us. We sit in front of 12 banking partners. So one integration, one onboarding, and as banks change their risk appetite, we can just flip between different banks and different institutions. So I really think that was one massive defining point. I think another one that is really big for European businesses is the introduction of MiCA. I think it's a great first step, and I think it's a great launch. And I can cover off more later how regulation is playing a role globally, but. Is it the right move? Is it the right stance on stablecoins, for example? I'm not too sure. I think it's the MiCA regulation is about 2,000 pages. I haven't met a single person that said they've read all 2,000 pages of it, so I don't actually know what's in there.
We're not going to ask who's read it.
Exactly. So I think those are two massive moments, and I think everyone's now looking at how MiCA is rolled out, what happens there, and they're going to kind of launch that, and that's going to influence maybe what the US does, what other markets do when they try to regulate this. But
Sure. Defining moment for Elwood Technologies. A couple comes to mind. We had a Series A in 22, and just after that, we recognized that there was a need in the market from an institutional perspective. There really wasn't regulated software that was out there for the institutions that at least I worked for. Big hedge funds, banks, or asset managers. They wanted to make sure that there's a robust, resilient product that's out there. And so we decided to go from our origins, which was essentially an EMS, to an OEMS, PMS, risk system, IBOR. And so we see we see institutions across the, different categories. And when we made that decision, it was validated with FTX. And during the FTX crisis, our clients were able to trade across ecosystems, obviously not on FTX, but we were able to help them from a risk management perspective, collateral management. We are support 24/7, 365. So that was a defining moment, and it was good to feel that and see that the business strategy change was validated. I think the other one was, mentioned SAB 121 and then the ETF. We were an OTC desk. We had an OTC desk, and we decided to divest that OTC desk and focus on fintech and providing software for the institutions that are coming to the space. And I agree with my colleagues here that since the election, really since the ETF launch, since the election, SAB 121, we've seen a steep curve in, we're educating again. We're educating again. We were educating before FTX, and now we're doing it again. And I was at Boca last week for the FIA conference. Just a quick story, quick takeaway was there were two types of, two feedbacks that I got. One was essentially, we know digital's here to stay. We are prepared or preparing for it. We know digital, the other one is we know digital is here to stay. We have no idea, how to engage with it. And what I took away from that is they want to partner with institutions or technologies where we can provide or integrate data back into them. And that's what we do. They're looking for reporting. They're looking for risk metrics. They're looking for real-time reconciliation. They're looking for help. And it was very, very, very good to hear that they're looking for help. And I think it's great for this industry. One last thing. I think the industry needs to come together and work together in order for us to go and partner with the institutions. The institutions are looking for help, and we have to do it together. So I'll pass it.
Look, I think there's dozens of defining moments, as you clearly said. I'll try to pick some different ones, but maybe piggyback on some. So there's two that I think about. Number one is the blow up in the lending markets that hasn't been mentioned yet. And the second is the launch of the US Bitcoin ETF is a major milestone and a watershed moment. But on the first one, that started to unravel in 2022. I think it was May of 2022 when UST Luna blew up. And then the following month, Three Arrows, who was a large borrower from those lenders, defaulted. That started this domino effect. And ultimately, you saw the likes of Celsius and BlockFi and ultimately ending with FTX. But I think it's important to kind of unpack those business models. Very early on, they were basically raising capital from retail investors, promising yield that those assets sat on their balance sheet. They then lended those out on the other side and captured a spread. And so when the market became a little bit quiet and they couldn't lend those out, some of those lenders started using very aggressive terms. I mean, some terms we've heard are $300 million uncollateralized. You don't even find that in the traditional space. Worse than that is they were lending to firms that didn't even produce financials, let alone audited financials. So I think when we look back, we're going to point to the wild, irresponsible, unsecured lending as an area that blew up. On a more positive note, the launch of the US Bitcoin ETF is certainly a big moment. It's important for one thing and one thing only. It truly opens the US market. The US market is a very, very, very equity-centric market. And derivatives are effectively a sideshow. If you look at the number of futures accounts versus equity accounts, it's a fraction, right? So it's not to say derivatives are not central to investing, but getting Bitcoin into a regulated, acceptable equity format is the last and final step in opening the US. And so with that, we've seen greater liquidity, greater product development, options, ADRs coming online. There's been a net positive on the native Bitcoin cash market. Greater flows and new entrants require greater accountability and greater accessibility, and so overall was a big moment for us. I think the other one that we didn't talk about is just like the ETF to help maturing the market. The recent talk by central banks to potentially put digital assets in their reserve could actually be the inflection point going forward. If Bitcoin is a permanent store of value, then it would absolutely make sense that central banks would hold it like gold. Gold is expensive to purchase and expensive to store. It's expensive and environmentally difficult to get out of the ground. Bitcoin is a much more efficient store of wealth. And so, again, I think this could be like the year that it happens. Geopolitically, we're in a period of sustained inflation and protectionism. So I couldn't think of a better setup for a hard asset that preserves value. So we'll see how it unfolds, but that could be the true, way that Bitcoin finds its full expression. I'll pause there.
Yeah, well, kind of going back to the infrastructure. I mean, if we look at the crypto-specific infrastructure today versus the parallel of the traditional kind of market infrastructure, and if you had to look at what has been potentially just created for crypto usage, I mean, 24/7 markets, very fragmented, et cetera, probably brings like more complexity than potentially even in traditional market. And if you had to compare it to the journey of other asset classes that we've seen over the last 2 or 3 decades, how would you qualify, looking at your own business, what is an evolution or kind of an integration of what has been done in traditional market, and what's more like a bit of a revolution of a new way of doing things? Maybe just starting on the PB side.
I'll kick off. So through the lens of a prime broker, we actually view digital assets as very similar to traditional assets. In fact, on the technology side, we wrote a single horizontal clearing infrastructure using modern technologies and techniques, kind of from high frequency trading, and bolted that into a clearing business. That's important because it allows us to have a real-time holistic view of a counterparty's risk, cross-asset, cross-product. And so it's the same platform that I clear foreign exchange, listed derivatives, fixed income, that I do digital assets. And so from a technology perspective, don't see much of a difference there. As a prime broker, we do basically 4 things. They're all very similar to digital assets as in traditional markets. The first is that our actuaries are experts in underwriting counterparty credit risk. And so that underwriting process of counterparties is very similar. The types of institutions in crypto may be smaller. There's a little bit more on the KYC and the wallet side of things, but ultimately the process is similar.
Are you able to integrate DeFi as well?
We don't support DeFi at the moment because of the KYC scenario, and that's a problem for that. But we're starting to see permission pools, so at some point. But just to kind of quickly finish, the other 3 things that we do is we manage liquidity that's on our balance sheet as we provide sheet to the street. We manage term liquidity, so we give term loans, same kind of concept in traditional as well as in digital assets. And finally, the actuaries set a series of limits for our counterparties. So again, on the technology side, the way the mechanics of this work is we set a series of limits. We push those out programmatically to all of the destinations where clients trade. They trade. We consume in real time post-trade drop copies or those events to the edge of our system. And we do effectively 2 things. One, we put it in our ledger. And so that's the books and records, and spits out a series of reports, regulatory reporting. And the other is into the risk engine, which recomputes the risks and pushes out new updated limits. So again, very, very similar. There are the nuances that digital assets is 24/7. You have different tenures and settlement windows that could be, instant. You have different decimals, and those don't fit into some of the back offices of traditional players. But overall, again, we see it similar. The last thing I would say is on the evolution side, I always comp digital assets to foreign exchange. And if you look at that market, how it evolved, it was started by institutions and then retail came in. Digital assets is the opposite. It started by retail and you have institutions coming in. So we have a different set of problems on a different period on the evolution adoption curve.
Okay. Chris, did you have to rebuild the whole kind of layers infrastructure of the PMS, or were you able to adapt and make it evolve to properly address?
Mike stole my thunder. So I'm just kidding. Look, Mike said it correctly. It was a retail market. I believe that it was revolutionary, right? It really was. If you think about it, peer-to-peer, it was brilliant. I mean, nothing short of brilliant that the products that are coming out of the digital asset space, for sure. But it is retail. And if you want institutions that are regulated to participate, there needs to be a coming together, so to speak. Just for example, it was mentioned before, 24/7, 365, that's a big deal. That's 40% more support. 40, 2 extra days a week. How do you manage your risk on the weekends? How do you manage your portfolio on the weekends? Do you strike a NAV on Saturday and Sunday? We solve all that. But ultimately, the way I think about it, in order for this space to really take off, and if we are institutional, we are regulated, we are seeing an increase in closings and education and demos and all that. But predominantly what I think needs to occur is that there needs to be settlement clearing, essential counterparty clearing, which Mike has touched on, which is his business. So I'm not going to go into that in too much depth. But in TradFi world, where I came from, the PB network, FCMs, PB equity, PB FX wheel, The banks settled on behalf of their clients. The market and global capitalization, market capitalization took off exponentially. So if you want this space to take off, we need to have settlement and clearing in a safe and secure way, and credit, cross-margining. The next one is we have jurisdictional fragmentation. I mean, it's honestly, I probably could get in trouble saying this, but I find it absolutely unbelievable that the perp contract, which I think is fantastic, is not in the United States. I really do. And a U.S. person can't trade that product. So how do we solve that? Really, we have three options. Either the international derivative exchanges change their framework to operate in the United States, or the U.S. person is allowed to trade on those exchanges and to access those products, which are innovative, or the U.S. builds those products. And if the U.S. builds those products, we're going to have a bifurcated market, right? Which is more fragmentation, which is what we don't want. And so, I think it's very important that that's solved. And lastly, I'll finish up with this, is standardization. I mean, there is no standardization because it was a retail market, marketplaces, and the infrastructure that was built around it was to mitigate that and give you access. There's no standardization. And Mike touched on it, and so have others, for APIs, right? In the traditional world, we have fixed. The APIs in digital world are not standardized and they have issues. Symbology, decimals, workflows, processes, product fungibility, right? Each marketplace has their own products. So I think the industry, we've done a great job and we need to pat ourselves on the back. It's been amazing, but we need to standardize and we need to come together and work with the coming institutions because they're coming.
I love that we're just going up and down the line, but I'll go next.
You're going next, but what I've been curious, I mean, obviously you're providing the on-ramping, off-ramping, the banking like service support that many of the bigger potentially kind of institutions are not yet willing to provide. How do you see this kind of evolving over the years? You're going to be an add-on, you're going to be a facilitator, you're going to compete with the banks?
So I think this is where this industry talks about, so like I said, I've only been in this industry 9 months, but there's too much of this them versus us mentality. It's them versus us, TradFi versus DeFi. And if you look originally when fintechs were kind of invented or came about, everyone thought that the fintechs were going to come and eat the lunch of the banks, right? The big banks were like, no, it's against fintechs. But realistically in the world, you needed both, right? You need the ones that have been successful is where a fintech has learned to work with a bank, where you get the innovation that fintech brings, you get the speed to market, the talent that go and want to build new cool stuff, and then you get the customers and liquidity that a bank provides and the scale that a bank provides. The two of those you can't compete with. And I think that's what's going to happen to this market. I think there's things that we do extremely well. I think there's things that the traditional finance market and traditional banks do a lot better. So if you look at something like the Basel Accord that allows standardization globally on how banks work across the globe, there's no standardization if we go to regulatory setups. If I want to get regulated in Dubai versus Singapore versus any other market, maybe come to the US, there's no standardization. What I need to do in one market is completely different to something else. And because this market is moving at such speed, we're making mistakes. I mean, not to go into too much detail, but things like APP forward in the UK is in concept to protect the consumer is a great thing. You want to be able to support them. You want to make sure that you cross out fraud. But the way it's been implemented just instead stops people wanting to work in the market. So you get anyone providing retail services to consumers just pull out of the market. They just don't want to do it. And then businesses like ours are then left in limbo, understanding the rules, what we're liable for, how much we need to pay. So I think standardization, and it's using the same term, is one thing. And then one thing that maybe they could take from us is, again, using the same theme 24/7. So we see huge demand for our Blink network. A lot of people will have known like Silvergate's Send network. We basically have a Blink network that powers instant settlement for fiat 24/7, multi-currency, multi-entity. And that is something that I think TradFi would really need to adopt, is like this notion of, I can't transact after 5 p.m. on a Friday. It's just like, it's like, how are we still in that position? So I think there's things we can take from both, and we need to just stop doing them and us and just start working together and moving forward.
But is there, we see that there's real demand for some of these things, right? But I think, Chris, when we were doing the prep call, you mentioned that actually some of your potential clients that are more traditional, kind of larger ones, they don't want to trade over the weekend. They don't want to price over the weekend. They like long weekends, I guess. How do you, and I guess, we'll revert back to that, but where do you guys see right now the biggest demand? Is it from crypto bros? Is it more from traditional market? We're talking about the maturation of the infrastructure, but quite frankly, the infrastructure, the way it is today, for what you do, if you're a crypto trader, it's probably good enough. If you're a bigger shop, then you need more complex, you need the capacity to move balance sheet everywhere. So I'd be curious to see where do you see the biggest demand and how we can basically bridge that gap. Nikil, maybe you want to start with, I know you have a bit of a differentiating kind of view and approach to this, but from your standpoint, where do you see the biggest demand for your solutions today from your client base? Would be interesting, and then diverge more to traditional finance again.
Yeah, totally. How many of you guys are in traditional finance versus crypto? Raise your hand in traditional finance world. How many of you come from the crypto world? What do the rest of you guys do? It's like half the people. Okay, I wasn't sure if I was going to share this, but what I'm going to do is kind of like strip out any identifying information, secret plans, all that kind of stuff, and share what we're seeing. So to give you a sense of scale that we do, I think I mentioned earlier, we do like over $100 billion in transactions annually, every country in the globe. If you're using something in crypto, we're probably powering under the hood. There's a secret playbook that we are developing for financial institutions, and it's obviously different financial institutions, a bank versus a consumer fintech app versus an asset manager, have different needs and different customers and different products. But in broad strokes, there's a playbook, and here's the playbook. It's 3 pieces. Number 1, you give users access to crypto. That can be in whatever form. It can be an ETF. It can be in you custody crypto and Bitcoins and ETH for your users. You build a system that lets them self-custody. That's one of the pieces of software we have. Users can come self-custody assets. In whatever form, you let them access it. Because if you don't let them access it, you are going to lose that user. I actually just moved all my money from JP Morgan to another bank, because hopefully they don't watch this video and see that, but because they didn't allow me to custody my crypto there. That's number 1. The second one is utility. Now that you have your crypto there, what can they do with it? Can they access DeFi loans? Can they get yield on it? Can they lend it out? Can they do staking with it? And the reason it's really valuable is because there's a lot of ways you can make way more money on yield on your crypto than you can on a dollar. And that is something that all users will want. And if you are a asset holder, or you hold assets for your customers and you don't let them do that, they will move somewhere else. That's piece 2. So number 1, hold crypto. Number 2, use that crypto. Number 3, the kind of next piece that everyone's really excited about, bring your existing business on chain. Is that stock trading? Is that real world assets? Is whatever your product is, make a tokenized version of that. And you get a lot of the benefits that these guys were talking about before, 24/7 trading. It's much cheaper on the, much less complex and much cheaper and much faster on the back end side. It allows you to tap into new markets. It allows you to tap into a ton of liquidity. And if you look at the US Treasury bills, stablecoins, and this was several months ago, is like the 40th largest holder of US Treasury bills, more than most countries in the world, right? So stablecoins lets Treasury bills have a massive user base that they couldn't have before. So, and then there's one kind of secret fourth thing, which we'll talk about. So first one, access funds or hold your funds. Number 2, use those funds. Number 3, bring products on chain. The fourth one is launch your own chain. This is a really, really, really exciting, unique opportunity. It will only be around for next 6 months to 1 year. But I don't know if how many of you guys know this, but Coinbase actually launched their own blockchain, and they make hundreds of millions of dollars on that. And you can think of it as owning like a credit card network effectively. You get to be Visa and you get to take interchange fees. And today, there's no dominant traditional finance blockchain. The first couple people who come have that opportunity to do that, whether it's a massive bank or a fintech, everyone's rushing to do this. So that's kind of the fourth secret piece. we actually power all those solutions. So if you're interested in learning more about this, reach out to me, come see me afterwards. I think I see Paul over there, right there. Come talk to him or email me. My email is just nikil@alchemy.com. But the point here is like, there is a gold rush right now. The winners will be set in the next year, but after that, there will still be a lot of opportunity, but whoever acts first will have this like magical opportunity and untapped potential.
Cool, thanks. I mean, clearly you're talking to people that are moving fast, and there are some people that are moving less fast. But so, I mean, kind of, Chris, going back to the point you mentioned where we're preparing for this, i.e., the demand you see, and I mean, what realistically we can provide as infrastructure, and what is the real demand, and what do you think could be those additional kind of features that could actually kind of bridge that gap and facilitate like the better integration over the next few months? What do you see as the major ones?
Well, like I said, I was at Boca last week for FIA. We are institutional, so we're predominantly a buy side, front to back, end to end, OEMS, all the way through the IBOR, risk system, portfolio management. So we are modular. What we're seeing recently is some of the digital infrastructure providers or custodians are asking for our help in one part of our product, specifically around reconciliation, because we've built a scale reconciliation from the old institutional side about tri-party reconciliation. We built it out at scale. Just one aspect. We are definitely seeing digital natives that are institutionalizing, asking for some help with respect to making sure that our forte, which is essentially accurate record keeping and risk and trading. And so we help them in that regard. We're seeing that. That's occurring as we speak. Okay. For institutions and hedge funds, we're seeing more and more. We are educating. We are in talks with a large asset manager about how we can support them, an international multi-billion asset manager, not a hedge fund, asset manager, how we support them and build out bespoke reporting. So it is occurring and we are seeing it. And because we are end-to-end and we are modular, we're being asked for specific parts of our stack. Yep. So preferably, we would prefer turnkey, where someone comes in and they trade with us. But we know that EMS is, in the TradFi world, commoditized in many ways. But post-trade, I think that we're seeing more and more, demos every day and closings, and we're doing well, and it's good to see, and it's occurring. Yep. But it's definitely started in my view, since the ETF, SAB 121, and the election, and it picked up significantly.
Cool. Tim, do you need like more banking relationship? What are the next step for you? I mean, is it kind of having a broader, kind of more stable network, or is it better kind of solutions for the end clients? What's the thing that's going to make the change?
So I think for BCB, it'll be kind of doing what we do, just expanding our footprint. So whether it's regulatory wise, it's we plan to get regulated in the Middle East, in Singapore, and then hopefully come to the US as well. So that's going to be big for us. We're always looking to grow the currencies that we support. At the moment, we support 30 plus currencies, but we need to keep on adding on local rails for that. I think that's going to be a big thing for us. But also the demand we're seeing from institutional clients at the moment is. It's one thing you said about wanting to get into kind of Bitcoin treasury is a big thing. I think you just see the success. I actually heard a great story once about Metaplanet's success, where they were the best performing stock last year. And it turns out that in Japan, apparently it takes 6 weeks from you wanting to buy crypto to actually being able to buy it. And the final step is they have to send a physical postcard to your house to prove it to you, like an actual postcard. And so it's so complex to get it that people are just buying Metaplanet stock because it's they're just a Bitcoin treasury business. And so that, along with moving into again stable coins mentioned, the ability for bridging using cross-border payments with stable coins, We have the ability to kind of take in any currency and pay out any currency, whether it's coin, whether it's stable coins, whether it's fiat. So I think expanding what we do, expanding our coverage, our Blink network, those are kind of the key things for this year that we're definitely going to see coming.
Cool, thanks. Mike, do you want to bring more traditional players to crypto or more better solution to crypto traders?
I think
what's the biggest push?
I think we still need, like, we're really far away from the basic building blocks, right? Investors, retail and institutional, have their assets invested in 6 assets, right? It's equities, credit, rates, real estate, commodities, and cash. If crypto's the 7th, then its trading and investment mechanics need to migrate towards other asset classes that trailblaze before them. And so that'll be a number of things. It'll be financial transparency. We need to get into this space. You need to improve clearing, custody, credit. We need to separate. The number one thing we need to do is separate the function of trading from the function of asset holding and collateralization. And by doing that, it'll lead to best practices across both of those disciplines. Once those building blocks are in place, then the institutional users can come in. And I'll give you one quick statistic. Foreign exchange markets in 1995, the Bank of International Settlements did a report and showed the market turnover was $1.2 trillion a day, with zero going through PB because the infrastructure wasn't there. Fast forward to 2019, the market cap grew to 6.6 trillion, with 1.5 trillion a day going through prime brokerage. So it just goes to show, as you lay down infrastructure, markets can scale. Prior to PB coming online, there was no industrial scale in foreign exchange. There was a few bespoke deals. There was no broad usage. It was just the mega names, the Tudors, the Soroses, the Moore Capitals. And because there was lack of institutional grade infrastructure, a lot of institutional capital sat on the sidelines. Similar story in crypto. Lack institutional infrastructure, institutional capital sitting on the sidelines. So once you solve that, then the institutions will come in. But I think my colleagues, did a great job, and the retail who built this out has been exceptional. And so we need to work together with that. My fear is shoehorning it into existing stuff that might suppress when we have the opportunity to create something new and unique.
Cool. Well, I mean, thank you guys. Thanks very much. I'm not sure we've fully there in terms of maturity, but I think we've gone a long way already. Thanks very much for sharing your experience.
Thank you.
Thank you very much.
Thank you.